You split a $400 purchase into 4 easy payments. Sounds harmless, right? $100 a month, barely noticeable. But then you check your bank account a few weeks later and it doesn't add up. There's a late fee you didn't expect, an overdraft you didn't see coming, and somehow you're still paying for something you bought 3 months ago. If that sounds familiar, you're not the only one. Millions of Americans are quietly falling into the buy now, pay later trap right now, and most of them never saw it coming. By the end of this video, you'll know exactly how it works, why it's designed to feel invisible, and what to do if you're already in it. Buy now, pay later has exploded. Services like Klarna, Afterpay, and Affirm are now embedded into checkout flows at thousands of retailers, from Amazon to Target to your favorite clothing brand. In 2025, American consumers took out more than $100 billion in BNPL loans. That number is still growing, and here's what makes it different from a credit card or a personal loan. BNPL is designed to feel like it isn't debt. No interest banner at checkout, no credit check, one tap and you're approved. The friction that normally makes you pause before borrowing, it's been engineered out of the process. And that's exactly what makes it worth paying close attention to, especially if you're already managing student loans, rent, and a checking account that isn't always as cushioned as you like. Let's walk through a real example. Meet Jordan. Jordan lives in Austin, Texas. She's 26, earns about $45,000 a year working in marketing. She's responsible, pays her rent on time, is slowly chipping away at her student loans, keeps a modest balance in her checking account. One afternoon, she needs a new laptop for a side project. She finds one for $400. At checkout, Klarna offers to split it, 4 payments of $100 every 2 weeks. No interest if she pays on time. She thinks, I'll barely notice $100 every 2 weeks. And honestly, it sounds true in that moment. $400 laptop, 4 times $100 payments via Klarna. Auto debit from checking account. Payment 1, fine. Payment 2, fine. Payment 3. By the third payment, Jordan's checking account is thin. Her car insurance came out the same week, she forgot the auto debit was scheduled, the Klarna payment pools, her account dropped below zero, her bank charges a $34 overdraft fee, and because the Klarna payment itself partially failed, she gets hit with a $7 late fee on top of that. A $400 laptop just cost her $441, and she still owes $100. Jordan didn't do anything reckless. She made a very ordinary decision in a very ordinary moment. That's what makes this worth understanding. The micro-debt illusion. When you break a purchase into small pieces, your brain genuinely perceives it as cheaper, not just more convenient, cheaper. Researchers call this pain of pain reduction. BNPL apps know this. The result? Studies show roughly 25% of BNPL users spend more than they originally planned because the smaller number at checkout lowers their resistance. You're not weaker than anyone else. You're responding to an interface that was built to do exactly that. Loan stacking. Here's something most people don't see coming. BNPL services don't talk to each other. Klarna doesn't know what you owe Affirm. Afterpay doesn't see your Sezzle balance. So it's easy, almost effortless, to have 3 or 4 active BNPL balances at the same time without any one of them flagging it as a problem. About 60% of regular BNPL users report carrying multiple active loans simultaneously. Individually, each balance feels small. Together, they become a quiet mountain of microdebt, all with different due dates, all auto-deducting from the same checking account. The fee structure nobody reads. Most BNPL services advertise zero interest, and that's true, conditionally. Miss a payment and late fees kick in immediately, typically $7 to $10 per missed installment. On some plans, a missed payment also triggers a deferred interest clause, meaning interest starts accruing retroactively on your remaining balance. That 0% offer becomes something very different very quickly. Missing one payment can trigger a late fee, a possible retroactive interest, and a bank overdraft fee, all from a single $100 installment. The credit score blind spot. Here's the part that surprises people most. BNPL providers often don't report your on-time payments to the major credit bureaus, so you're not building credit by using them responsibly. But miss a payment, many providers will report that. Your credit score can take a hit for a $10 late fee on a $100 balance. The upside doesn't transfer. The downside does. The overdraft double whammy. Because BNPL uses automatic deductions, it doesn't check whether you have funds available before pooling. If your account is low on a deduction day, even by a few dollars, your bank can charge an overdraft fee of $30 or more. Jordan's story isn't rare. It's almost a design feature of how these services work. Why it feels harmless, the psychological hook. The reason BNPL is so effective is that it removes every mental speed bump that normally makes you pause before borrowing. No credit check, no loan agreement, no interest headline. The word loan never appears at checkout. It's positioned as a payment method, like using a debit card. But legally and financially, it's a short-term loan. That gap between perception and reality is exactly where the trap lives. I know what some of you are thinking. I always pay on time. I've never had an issue. And that might be completely true. Used once, intentionally, for a planned purchase you'd made anyway, BNPL can be a neutral tool. The problem isn't BNPL itself, it's that the way it's designed makes intentional use harder than it looks. The more access points you have, the more biweekly deductions you're juggling, the closer you get to a moment where one unexpected expense turns a cascading series of fees. The people who get hurt aren't usually reckless. They're just busy, and the system isn't forgiving of busy. Whether you're already carrying BNPL balances or just want to protect yourself going forward, here's what actually works. Step 1. Audit every active loan. Open every BNPL app you have, list each one: provider, outstanding balance, next due date, payment amount. Put it in a note on your phone, a spreadsheet, wherever you'll actually see it. Most people have no idea what their combined BNPL balance looks like until they write it down. Step 2. Stop new borrowing. Make it harder to start. Delete the apps. Remove saved virtual cards from your browser. This isn't about willpower. It's about reducing access points. BNPL relies on impulse. The checkout moment is the most vulnerable moment. If the option isn't one tap away, you give yourself time to make a different decision. Step 3. Negotiate before the due date. Most people wait until they've missed a payment to reach out. Don't. Contact the provider before the due date if you know you're going to be short. Klarna, Affirm, and Afterpay all have hardship or extension options. They're just not advertised. Ask for a payment extension before the fee triggers. Most will work with you if you call first. Step 4. Pay down balances strategically. If you're carrying multiple BNPL balances, two frameworks help. The snowball method, pay the smallest balance first to clear accounts and build momentum. The avalanche method, pay the highest interest or fee risk balance first to minimize total cost. Either works. The one you'll actually stick to is the right one. Step 5. Consolidate if it makes sense. If your combined BNPL balances are adding real stress, a 0% APR introductory credit card or a low-interest personal loan can consolidate everything into one predictable payment. This only makes sense if you're disciplined about not running up new balances. But for someone juggling 4 BNPL due dates, the simplification alone has real value. Step 6. Get free help if you need it. Nonprofit credit counseling agencies like Money Management International offer free budget reviews and debt repayment planning. No sales pitch, no catch. If BNPL debt is part of a larger picture that feels overwhelming, they're a legitimate, no-cost resource. The simple rule: before using BNPL, ask, would I buy this with cash today? If the answer is no, the purchase isn't affordable yet. BNPL doesn't make it affordable. It makes it delayed. A quick note: everything here is for educational purposes. Your financial situation is your own. If you're dealing with significant debt or need personalized guidance, a certified financial counselor or nonprofit credit agency is the right next step. BNPL isn't going away. It's going to be at more checkouts, embedded in more apps, offered in more moments. That's exactly why it's worth understanding now before it's woven into more of your financial life. Jordan's story isn't a catastrophe. A $41 surprise fee isn't the end of the world, but it's a preview of what happens when convenience is designed to outpace awareness. And the gap between a small surprise fee and a real financial headache is smaller than it looks when you're carrying multiple balances. You don't need to avoid BNPL forever. You just need to use it on your terms, intentionally, with a clear picture of what it actually costs and what it's quietly doing to your budget. That's the difference between BNPL working for you and you quietly working for BNPL. If this helped you see BNPL a little more clearly, a subscribe helps me keep making content like this. And if you've had a BNPL surprise of your own, drop it in the comments. I read them.